Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Stocks in Asia follow Wall Street lower. Treasury yields hitting multi-month highs, with traders on edge ahead of this week's Fed decision. Nvidia getting a boost after President Trump approves its H200 AI chips for sale in China. Financing standoff thaws. European leaders near a deal to use frozen Russian assets to fund Ukraine's reconstruction. Plus, family drama. Paramount enlists the help of President Trump's son-in-law, Jared Kushner, as it launches a hostile cash bid for Warner Brothers just days after the studio agreed to a deal with Netflix. So after a soft start to the week with Wall Street lower by the end of the close on Monday and losses of about 0.1% across the European benchmark by the close, today looking for direction. Equity traders seemingly on the sidelines until we get more clarity from the Federal Reserve, and anxiety, of course, building. We saw that in the global bond markets as to whether or not you get a hawkish cut from the Fed tomorrow. European stocks then currently flat in terms of the futures picture. Here in the UK, FTSE 100 looking to drop just 4 points so far. S&P E-minis then, after that weakness yesterday, currently pointing to just very modest gains of 1 point. Nasdaq 100 futures pointed lower by 5 points. Again, across the equity market, the picture is indecision and a lack of catalyst, maybe just on the sidelines until more clarity from the Federal Reserve. Let's flip the board and have a look cross asset then. The focus on global bond markets, given the sell-off that we saw yesterday, of course. 10-year yields stateside getting to the highest level we've seen since September. Today, a little bit of stability across the Treasury curve. You're at 417 right now in the US benchmark 10-year. You're up about 20 basis points in the last 30 days or so in terms of yields up on that benchmark. 133 on the pound. Some consumer retail data coming out softer, particularly over the Black Friday holiday. Some concern there maybe for the UK Chancellor. The spending impulse not coming through in the UK. The pound is up just 0.1%. Bitcoin back below 90,000, and Brent crude after the biggest drop in 3 weeks yesterday at $62 a barrel, down 0.3 again in the session, ahead, of course, of OPEC and IEA surveys and reports later this week. Let's cross over to Asia right now. Winnie Su standing by for a check on those markets in Hong Kong. Winnie.
Morning, Tom. So there is quite some caution here in the Asia session as well ahead of the Fed's meeting in case there is a hawkish tilt. And speaking of hawkish tilt, that's exactly what we got from Australia's RBA. Even after they have kept rates steady, still saying that they don't really see a further rate cuts to come in the near future. And hence, we are seeing the Australia-Aussie dollar here strengthening just slightly on that. In terms of Japanese yen, stabilizing here after having weakened overnight following that big earthquake in the northeast side of Japan. Yields not moving a whole lot. We did get that weaker than expected 5-year bond auction, and that is not really out of surprise just because we are betting for the Bank of Japan to raise rates in the next few days. Now, flip the board and take a look at what's going on in the Chinese market, because China stocks actually quite a big drag to today's Asia session, and that's mainly driven by some of the disappointment coming through from yesterday's Politburo readout. There wasn't much mentioning on the consumption side of things or property, and hence you're seeing property stocks falling a lot here. And another sector that we're keeping a close eye on is on the Asian chips as we flip the board and take a look at what's going on there, because we've got news on how Nvidia got approval from Trump to sell their H200 chips to China, and hence you're seeing competitors here in China falling and suppliers in Japan actually rising. But the market's reaction is actually quite muted, as we're hearing from investors that they're still waiting to see how much China appetite we're actually going to get for these chips. Back to you, Tom.
Winnie Su in Hong Kong with the check on the Asian markets and a touch, of course, on what's happening in the semiconductor space. Let's get more details right now on that story. Nvidia's share price surging in after hours, trading, of course, after winning President Trump's approval to ship its H200 AI chips to China in exchange for a 25% surcharge. It paves the way, of course, for the chip maker to potentially regain billions of dollars in lost business from a key global market. Our Asia Tech correspondent Annabelle Drillers has the details, joining us from Hong Kong. Annabelle, how significant then is this potentially for Nvidia?
Well, I mean, potentially it's extremely significant because, as you said, this is looking at maybe a multi-billion-dollar opportunity in the Chinese market. We don't, of course, understand exactly at this point exactly what Beijing's policy response is going to be. We had President Trump, who confirmed this news in a statement on Truth Social overnight, saying that he had spoken with President Xi and that Xi had responded positively to that. But at the same time, of course, it's something we don't know just yet. And Nvidia itself as a company actually removed China from any revenue estimates in its latest earnings. So again, they're not having anything factored in just yet. But the H200 chip being allowed to restart or to be sold into the mainland market is what our team at Bloomberg is saying is really one of the most significant pivots we've seen from Washington on this, because right now, or previously, it was the H20 that the Trump administration sort of flip-flopped on, but ultimately said could go to China. The H200, though, still from the Hopper series, but a chip that was actually designed for the international market. H20 was just for China, but H200 has significantly greater bandwidth, also compute power. It was the first chip to actually integrate HBM3E, but also it's a chip that was on sale just as late as last year into markets. So China is going to be close, not in the most recent architecture. That's Blackwell right now. We ramp up into Rubin architecture next year, but again, not too far behind them. And this is the most advanced technology that they've ever been legally able to access.
Yeah, to your point, this is a whole different beast, isn't it, to the H20, the H200. I guess this is a question, Annabelle. I mean, you follow this very closely indeed, given where you're located. But China was able to jawbone and pressure its tech companies and its hyperscalers and its AI developers not to take on board the H20, not to stock up on that and to lean into some of the domestic players. Can they really afford to do that if the H200 is now potentially knocking at the door? What is demand in China likely to look like?
Yeah, exactly that, though. I think we just don't know at this time. I think it really depends on how China wants to look at this situation. As you said, the H200 is significantly more technologically advanced than what they've ever been able to access. It's also a chip that's very good at inference, and inference chips, as opposed to training, ones that are better at training, which is the chips that are really needed when you're building up the foundation models. It's more at that point of inference when you're starting to deploy that technology through the economy, through different businesses, industries as well. So as that sort of need continues to grow in mainland China, it of course makes a chip like the H200 look really appealing. At the same time, as we know, China is trying to build up its own self-reliancy and self-sufficiency in this space. And we have seen companies like More Threads. We had that IPO last week here in Hong Kong. Very strong debut. It's a company that's pursuing fully functional GPUs and wants to as well build up its AI capabilities. You've got another chip designer, Cambricon, as well, that's doing well. There's MetaX. There's a range of different companies in mainland China that are all pursuing this sort of technology. Of course, they're quite far behind Nvidia at this point, but at the same time, as I said, we just don't know exactly how it will pan out.
Okay, important context. Bloomberg Asia Tech correspondent Annabelle Drillers. Annabelle, thank you very much indeed for that update and the details, of course, on how to think about the Nvidia story. Treasury yields, meanwhile, climbing to the highest in more than 2 months. Following losses in most global government bond markets, it comes as Fed policymakers begin their crucial 2-day rate-setting meeting today. Let's bring in Bloomberg's Sonali for the market take on this. Val, the market's adjusting then. A bit of stability in the Treasury curve today, but yesterday it was pretty pronounced, and not just in the US.
Yeah, not just in the U.S. It was a pretty brutal session, even for European fixed income yesterday. We've really seen this yield rise now start to dent the equity market sentiment. The yield rise, at least in the Treasury market space, it dented the S&P 500's 4-day rally. It snapped that winning streak yesterday. We're coming up to very close to 420 levels on the U.S. 10-year. Those are kind of levels we haven't seen since August. And even more surprising, given that we ended the last trading session of November hitting 395. So a near 25 basis point rise in these U.S. 10-year Treasury yields in the month of December. I do also want to tag in the context of what's been going on in front-end pricing as well, because we have seen a hawkish shift when it comes to what traders are expecting the Fed to do in 2026. Flip the board and take a look at how Fed expectations have changed over the last few months. It was just back in September, Tom, that we were pricing in 150 basis points of cuts next year. We have now slashed that in half. The market is now pricing only 75 basis points of cuts. That's 325 basis point cuts from the Fed over 2026. And this pairs with what we've seen with other global central banks as well. We're now pricing in more hikes from the Bank of Japan. We're also pricing in a very slim chance, a 20% chance we get a hike from the ECB in 2026. So these last 2 weeks have really been about a hawkish shift in the front end. You could actually argue within this context, it's very surprising even to see global equity markets, the S&P 500, so close to all-time highs, given this hawkish shift in the front end. But let's add the more risk events that we have headed into Christmas. It is very likely that if we get such a muddled message from a fractured Fed decision, the market shifts its focus to this backlog of data yet to come. We're still waiting on that November NFP and that November CPI. Perhaps the market could be due for a further repricing of the front end, depending on how that data comes in next week.
Bloomberg's Valerie Tatjana, thank you very much indeed. Let's get to what's happening in terms of movements around potentially additional support for Ukraine coming through from Europe. Bloomberg told that European leaders are optimistic they will reach a deal to use frozen Russian assets to fund Ukraine before Christmas, following those talks in London. The EU estimates Ukraine will need 135 billion euros over the next 2 years to keep basic services running and to prop up its military. Bloomberg's chief Europe correspondent Oliver Crook joins me now. Ollie, what will this mean for Ukraine and what message does it send to Russia if indeed the Europeans do finally get this across the line?
If indeed, Tom, is the sort of key part of that sentence. And I think that that's what we'll be hanging on over the next sort of 10 days or so, going into next week to the European Council meeting that will be held here in Brussels, where European leaders will have to come to a consensus and potentially move on what would be the most significant contribution I think the Europeans can make to this negotiating process, to the efforts of Ukraine to defend itself against Russia that they've made over the last few months. If they are able to get this over the line, Tom, this would account basically 90 billion euros worth of funding for Ukraine over the next period of time. As you say, that goes about 2/3 of the way of covering the funding that they require for running the country and running the military, which is about 135 billion. So that would be a major step. In terms of this signaling, this would signal a couple of different things. One, that the Europeans are still sort of relevant players potentially in this conversation. This may be a way for them to earn themselves a seat at the table. Remember, they did come under pressure from the Trump administration over the last couple of weeks. We've just had that reporting out from Bloomberg that basically the Trump administration was telling them not to touch the Russian assets because the Americans wanted to use it in their own negotiations and for their own peace framework. That would change it drastically. And even if there is a peace proposal in the next couple of weeks, or if there isn't, regardless, Ukraine will require this money. But if there is a peace agreement, this completely changes the calculus in terms of the negotiating position for the Ukrainians. I mean, it's the difference between having $90 billion, or $100 billion in the bank to fund your war effort over the next 2 years. That will dramatically change the calculus of the Russians sitting across the table for them. So if indeed they're able to move forward with this plan, it would be a hugely significant development for the Ukrainians. And in fact, something that Volodymyr Zelensky told me a couple of weeks ago was a matter of survival for them.
Ollie, we're just getting a breaking redhead right now. You may have some more context around this then. German lawmakers, meanwhile, approving a record 52 billion euros in defence orders. German lawmakers set to approve 29 military procurement contracts worth at least 52 billion euros next week. That is part of the government's push to transform the Bundeswehr armed forces into Europe's strongest conventional army. This coming through just in the last minute or so. At a time, of course, Ollie, when we continue to watch for any progress when it comes to that US-pushed peace deal between Ukraine and Russia, it's a reminder, of course, that Europe and Germany in particular continues that push to rearm in ensure it has the defence capabilities. Where are we? First of all, if you have a view on this or a comment or anything to add, that would be helpful. Yeah. But equally, where we are on that peace deal as well, Ollie.
I think for the Germans, and you hear this from the Americans, and I've heard this from a number of American officials, and we actually saw this in some of the comments from Pete Hegseth over the last couple of days, saying that basically Germany is now considered by the Americans a model ally, in large part because of their commitment to defense spending. And we're talking about, huge huge amounts of money being spent by the Germans. Of course, there was the amendment to the debt brake, which means that $500 million to up to $1 trillion worth of spending could go towards the military. Now you have a record approval of 52 billion euros to go towards the military. And we spoke to Rheinmetall last week. They really are leading the charge in Europe. And so from the American perspective, this is satisfying one of their great foreign policy goals, which is the Europeans taking more responsibility for their own security. The problem, Tom, is that takes many, many years to build up. And this is just the sort of beginning of that process. As far as the peace process goes, and this is why the Europeans really are not at the table, because they failed to build up their military over all of these years. We understand that now we went from a 28-point plan to a 19-point plan. I understand we're now at a 20-point plan. We still don't know the sort of entirety of what is contained within it. I think that is the difficulty that we're getting from Volodymyr Zelensky. We spoke to him yesterday, and he was saying fundamentally there is one question that he and all Ukrainians want to get the answer to. If Russia starts the war again, what will the partners do? And I think that even more important than the very, very, very difficult issues around territory in the Donbass, the question for the Europeans is what is the mechanism of defending Ukraine? Will the United States have a sort of backing for Ukrainians? We understand that Volodymyr Zelensky would like legally binding security guarantees from the U.S. that are approved by Congress. But again, Tom, we do not know the details of this yet. We'll have to wait for that until we get sort of closer to the finishing line for those to get public. In terms of diplomacy today, we'll watch Volodymyr Zelensky heading to Italy to meet with Giorgia Meloni.
Bloomberg's chief Europe correspondent Oliver Crook. Ollie, thank you for the detail and responding, of course, to those breaking lines on German defence spending. Here's what's coming up. We're going to switch focus because Paramount has ramped up the battle for Warner Brothers with backing from someone very close to President Trump. We bring you the details on that story. That's coming up. This is Bloomberg.
Today's move was entirely expected. We have a deal done, and we are incredibly happy with the deal. We think it's great for our shareholders. We think it's great for consumers. We think it's a great way to create and protect jobs in the entertainment industry. We're super confident we're going to get it across the line and finish. So we're excited.
I know the companies very well. I know what they're doing, but I have to see what percentage of market they have. We have to see the Netflix percentage of market, Paramount, the percentage of market. I mean, none of them are particularly great friends of mine. I want to do what's right.
Comments from President Trump and Netflix's co-CEO, Ted Sarandos, there after Paramount launched a hostile takeover bid for Warner Brothers at $30 a share. President Trump's son-in-law has emerged as a player in Paramount's fight for Warner Brothers Discovery, days after Netflix, of course, agreed to a deal. Deals reporter Manuel Baigorri joins us from Hong Kong. Manuel, what can you tell us then about Jared Kushner's involvement in this hostile bid?
Yeah, it's just getting better and better by the day, Tom, isn't it? It's just such a fascinating deal to watch and to follow. Kushner has become a very active deal maker through Affinity, and they are more and more visible in the deal-making space. I mean, there's so many deals taking place, particularly in the US, but also here in Asia and in Europe these days. It's just hard to keep track, but they are definitely a very active player in the M&A arena. So it's not a big surprise that they are kind of like backing Paramount on this potential transformative deal. It's just a bidding war now, right, between Netflix, Paramount, any other interlopers may show up. Who knows what the next steps will be, Tom. But definitely Kushner's involvement brings the political angle to the table. Trump has also been quite vocal about, the potential antitrust issues and how, important and critical this deal could be ultimately for the consumers as well and for the whole entertainment industry, not just in the US, but also globally. And then also very interesting to see how other backers for Paramount include Middle Eastern funds as well, right? Because obviously Trump has made it clear that the links with some of these funds and the potential investment into America are also quite important.
Where does this, Manuel, leave the bidding war then for for Warner Brothers. I mean, it is a fascinating list of characters in this bidding war drama now between Paramount and Netflix. What are you and the team watching for in the days and weeks ahead?
Well, the next steps, Tom, will be quite important over the next few days and weeks. Paramount has given 10 days for Warner Brothers to consider their offer. Obviously, there is going to be a lot of behind-the-scenes meetings and moves. Every step and every decision will be quite critical, with shareholders of each of the companies involved, with their advisors, with their financiers, and those providing financing is a big financial commitment. So there is banks, there is sovereign wealth funds, there is private equity involved, Apollo also backing Paramount. So as you said, there's a lot of really high-profile names, investors, and great ingredients for this story to be one of the most important in deal making at this point in time. The next steps, it could be multiple ways. We could see Netflix potentially coming back with a superior offer or an increased bid. It could be a response for Warner Brothers. Paramount could have something else to say. Other contributors may show up. So it remains to be seen. I think the critical next few days will be very important.
Okay, deals reporter Manuel Baigori in Hong Kong with the details and the latest on that bidding war drama. Manuel, thank you. Coming up, we're going to get to the oil market and the energy market, because oil has held on to its biggest decline in almost 3 weeks. The moves lower were pretty pronounced yesterday, weren't they? We have the IEA and OPEC reports out later this week. We're going to discuss what is driving the drop. That is next. This is Bloomberg. So oil steadying after the biggest drop in almost 3 weeks. Traders looking to reports this week to assess the extent of the glut. Let's bring in Bloomberg's Stephen Straczynski, who leads our energy coverage in Asia. Stephen, just break down what traders are so anxious about, what they're going to be watching for as well from these oil reports. We see Brent under pressure again today, just by 0.3%, so not nearly the same kind of pressure that we saw yesterday. But nonetheless, it continues, weaker prices around oil.
Yeah, I mean, first off, we're going to have the EIA report. That's the U.S. Government agency report that will show short-term, I think, give a better picture on what's happening in the U.S. Shale oil production has remained pretty resilient despite the drop in prices. I think there was expectation that you would see some producers really cut back the rig count, but oil output from the U.S. has stayed pretty strong, kind of adding to that glut narrative. So that's one thing they're going to look at. Also, how we're looking at inventories in the U.S. Then later in the week, we're going to get a better shot from the IEA, which in their previous report said that we were facing a very large glut coming into 2026, which is what the market is the most afraid of. Is that situation changing around these Ukraine peace talks? How is that playing into it, as well as lastly, OPEC Plus will be coming out with their report as well. And depending on what that report says on the state of the market, you could see maybe a shift of strategy. Now, OPEC Plus has, over the last 2 months, been essentially saying that they're going to keep their output steady. They're not going to increase output in the first quarter of 2026, which is a reversal of most of this year when they've done larger than expected increases. But depending on the state of the market, are they going to continue with that plan? Are they going to add more? Are they going to decrease? I mean, OPEC Plus remains a pretty large wild card in this market.
OK, OPEC Plus still that wild card as we see further pressure on oil prices today with Brent down about 0.3%. Bloomberg's Stephen Straczynski, thank you on what the oil market traders are going to be watching for, of course, with those surveys and reports out through the week. Coming up, we will be looking ahead to the Fed's rate cut decision on Wednesday, if indeed they do cut. That is almost fully priced into the markets. Our next guest, Tatjana Greil-Castro, co-head of public markets at Muzinich & Co., with her views and analysis. That is coming up. This is Bloomberg. Good Tuesday morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Stocks in Asia follow Wall Street lower. Treasury yields hit multi-month highs with traders on edge ahead of this week's Fed decision. Nvidia getting a boost after President Trump approves its H200 AI chips for sale in China. European leaders near a deal to use frozen Russian assets to fund Ukraine's reconstruction. Plus, Paramount enlists the help of President Trump's son-in-law, Jared Kushner, as it launches a hostile cash bid for Warner Brothers just days after the studio agreed to a deal with Netflix. Let's get to their markets then, and you very much get a sense of traders waiting on the sidelines after a little bit of softness, of course, on Monday on Wall Street. And European equities down 0.1% by the close on Monday. Today, European futures going nowhere, currently flat. FTSE 100 futures, a similar picture, just pointing lower by 4 points. S&P E-minis also flat. Nasdaq 100 futures currently pointing lower just by 8 points. There's a little bit more activity in the bond markets, or at least there has been over the last 12 hours. Let's flip the board and have a look at cross-asset then. Treasuries have stabilised to some extent, but you did see, of course, 10-year yields yesterday getting to the highest level since about September. The pound at 133, some further data on the consumer and retail spend over the Black Friday period pointing to weakness there, but the pound is up just 0.1%. Bitcoin back below 90,000 and Brent under pressure again after the biggest drop in 3 weeks yesterday, currently down 0.3%. We have OPEC Plus, their report coming out later this week, the IEA as well. So traders watching that as there continues to be question marks about the oil glut on the markets. Let's get more, though, on the Fed right now, because, of course, that decision comes through tomorrow. The outlook beyond December, arguably, is where the markets are already at. Tatjana Greil-Castro, co-head of public markets at Muzinich. Tatjana, always great to get your insights on, of course, monetary policy and how to think about positioning across fixed income. How concerned should markets be? Are we at a point now we're expecting a hawkish cut from the Fed tomorrow? Is that where you expect things to be framed by this Federal Reserve?
Let's see what the communication exactly will be. And I think now we're already down this, it's going to be a hawkish cut. So I think, well, clearly there's still a lack of data. So that puts them a little bit in a bind. At the same time, they have been very much focused to backward-looking data. And I think that probably got them into this space in the first place, right? I mean, I remember we talked a few months ago when it was still, Trump is trying to push the Fed into cutting, and because Trump clearly was saying they were behind the curve, then all of a sudden they changed into being more focused on employment data. So they were behind the curve. Where are we today? They're still behind the curve. They're cutting, so they're still above where the neutral rate is. So from here, if you're thinking that inflation is coming down, so it's still slightly restrictive. Yep. We do see continued strong growth. So personally, I think that allows them to cut 2 more times next year, no more than that. So from here, what we are seeing is inflation sticky, but not too high. I think they can sort of put a blind eye on it as long as the employment data remains mixed. They clearly argue the employment data is sort of pointing to a weak side. I think it is more mixed. So to me, that indicates that they want to cut more because you can interpret the employment data in different ways. So, if the language is maybe a little bit hawkish, could be, but I think the trajectory continues to be for further cuts. As long as the employment data allows them to do so. Okay, so you see them cutting tomorrow, and then you see them cutting twice more in 2026. How much of that is priced into the yield curve at this point? Is there anything in US Treasuries that's looking attractive at this point? So at the moment, really, what we look at from at the very short end, because clearly the Fed still needs to do the cutting, right? Yep. So the rest of the market the rest of the curve can be controlled by the market very more, but the very short end is very much controlled by the Fed. So that is benefiting the most from the cuts because you need the actual cuts. The market can't really anticipate it too much. You like the short end? So we do like the very short end, absolutely. And we also do, as a credit house, we also think that there will be lots of assets coming from the money markets as those rates are coming lower. And they will take one step into the market, which is short-dated credit, more so than short-dated rates, because it still pays you some extra and you contain the volatility. So for investors who want still don't want to be on the sidelines as much, but don't want to be fully in the market because the equity valuations, because concern about the steepness or further steepening. There is a nice place to be.
Does anything look mispriced to you in credit at this point?
In credit, mispriced. I mean, where we see there is less value is at the very long end, because there clearly it is mostly a duration play, and spreads are relatively tight in the long end. So if you long the long end, on the long end, maybe you just want to go outright Treasuries or the Bund or sort of be really sovereign invested. But then the belly still looks decent. And I think one thing we always point out is also that now as the yield curve is normalized, and even now the short end is normalizing, the ECB has already cut, the Bund is already normalized all the way through. But, the Fed is still slightly upward sloping. So to that extent, we do think that there is this additional return that investors often forget about, which is the roll down, right? And the roll down is a beautiful return generator. So with the yields and the roll down, you get a decent total return for next year.
How much do you think is priced into German bonds at this point? We've had the news today that German lawmakers are set to approve another 52 billion euros in defence orders. Is the spend, and are the markets able to absorb that spend from Germany, or do you expect a bit of a rebellion in the bond markets today on the back of that news?
Well, the one is always the announcement of those monies, right? And the next is the spending, and they're not very good at spending it. So we don't see that, sort of to come in immediately. Clearly there has been this talk, particularly as Schnabel pointed out, that she's known to be a hawk.
Yes.
To go and say, well, next thing I see is a rise in interest rates.
You don't agree with that, or you don't see that happening?
Don't really. I mean, and even that rise would be way out anyway, right? Even according to her. We still see, I know it's currently largely priced out, sort of a half a cut is priced in. We see there a chance to be another cut, and that is the growth figures. We'll have to see what the ECB will say next week, right, in terms of growth. And if there is enough of a rebound. But we see their import prices to affect inflation next year. And that is really, we know that China is exporting significantly, and Europe is one of the destinations.
So potentially another cut from the ECB, and part of that is the disinflationary nature of exports out of China. Before we let you go, do we get to 3% level for the Bank of England by the end of 2026? How far can the BOE go, given that there's still relative stickiness in services inflation?
Exactly. That is the problem, I think, for the Bank of England, is the inflation. Inflation is still in the 3.5%, service inflation 4.5%. It's very difficult to cut significantly if inflation is so elevated. Having said that, we see this with consumer sentiment in the UK. And with the continued increase in taxes on the private economy, clearly public spending continues to go up. Public wages also continue to go up, but the rest is feeling that squeeze. And so, I think depending on how the economy is reacting to this, we could see further cuts, and not quite to 3%, maybe 3.25%.
3.25% for the BOE, potentially by 2026, the end of 2026. Tatjana, thank you very much indeed. Tatjana Greil-Castro, co-head of public markets at Muzinich, potentially scope for another ECB cut and opportunities at the front end of the US Treasury curve. Now, the chief investment officer, meanwhile, of one of the world's biggest bond funds is warning of, quote, dangerous assumptions in the credit market. Speaking on the Odd Lots podcast, PIMCO CIO Dan Iveskhin said inflated ratings may be giving investors a false sense of security, just as the Fed faces limits on its ability to step in. The warning comes with funds competing aggressively to write loans once dominated by banks.
It is very, very dangerous to assume something has an investment grade rating just because the rating agencies assign a rating to it. It's critically important that you do your own credit work. Today, all too frequently, you'll have an investment grade rating from one entity. And again, market participants for years have always joked, if you can only find one investment grade rating, it's pretty fair to assume everyone else is below investment grade.
Well, here in the UK, Black Friday discounts failed to prevent a slowdown in retail sales as the government's budget damaged consumer confidence. According to a report by the British Retail Consortium, total retail sales increased just 1.4% year-on-year in November, below the 12-month average. The report adds to evidence that speculation of tax rises ahead of Chancellor Rachel Reeves's budget soured consumer sentiment during a critical period for retailers. Meanwhile, a US judge has ruled that President Trump's executive order banning new wind projects was illegal. US District Judge Patty Saris said the order, which Trump issued in January, is, quote, arbitrary and capricious and contrary to law, signing with more than a dozen US states and a clean energy group. The order froze dozens of clean energy projects, including massive installations planned off the eastern seaboard. President Trump has signalled he could impose fresh tariffs on agricultural products, including Canadian fertilizer and Indian rice. It's the latest sign that protracted negotiations with two US trading partners could drag on even longer. Two separate US delegations are in New Delhi this week for talks, but officials say they don't expect any immediate announcement of a trade deal. Coming up, as President Trump pledges to sign an executive order on AI regulation, how will it impact the rest of the sector around the world? We're going to speak to a leading venture capitalist, Sonali. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, President Trump has announced he will sign an executive order to establish one rule on artificial intelligence, which could allow the government in the US to limit state regulations it sees as being too restrictive. It comes as policymakers, of course, around the world grapple with how to regulate the rapidly evolving sector. Let's bring it at this point then. Sonali, the Rycker, partner at Accel, one of the world's leading venture capital funds, and of course a VC firm with some very notable names in its portfolio, including the likes of Lovable, N8N in Europe, Atlassian, of course, over in Australia, Slack, Spotify, Squarespace, CrowdStrike, Anthropic. The list goes on, and some really gold-plated names, and really fantastic to get you on, Sonali, particularly on this moment. This is at a time, of course, when we're looking back on 25 years for Accel, when you first opened your offices in Europe back in 2000. Before we get there, on this AI regulation story, does the divergence that we're seeing in regulatory regimes when it comes to AI between the US and Europe with its EU AI Act set us up for further step backs for Europe? Does this put the US at a material advantage, do you think, if this regulatory alignment actually comes to pass stateside?
Yeah, it's a great question. First, thanks for having me here, Tom. What I would say is that we're very much in the early innings of AI, and it's the most consequential tech disruption that we've seen. And as we've seen with regulation and regulatory initiatives, our view is that entrepreneurs should be left to do their business, and the more you can enable them, the better. And so the EU AI Act has sort of moved up and down. There's flux in it, and I think that's a good thing, because if you think about it, there's 5.5 billion people online. There's 9 billion people on mobile phones. So the access that everyone has to iterate and experiment, and we cannot take that for granted. And to stymie the entrepreneurs in this very crucial time, because it's a technology shift that's a multiplier effect for everything that we've seen that's come before. And so I think our view is leave the entrepreneurs to do their business. And does the US have a bit of an advantage? Listen, there's a concentration of hyperscaler talent. There's a concentration of AI frontier labs at the minute. But Europe is incredibly exciting. We have world-class AI research. We have entrepreneurs. We now have the role models. You just sort of mentioned the litany of some of the greatest companies that have been created. So we think that it's sort of slightly unequal at the moment, but we have a lot going for what is going in Europe.
Is Brussels listening to those concerns, and do you expect them to moderate the EU AI Act then?
You know, our view is that the people are listening. They see the level of innovation that's happening both here in Europe as well as in the US. We just released a report that showed that actually at the applied AI side, so not the model frontier labs, there's a 30 billion that's gone into companies across Europe and the UK. That's 2/3 of the number. in the US. So it's a very large number. And people see that we're moving forward at pace, the talent is there, we have world-class universities, the AI research that's coming out of Europe is very significant. And so it's a top consideration is how do you enable the European ecosystem, the UK ecosystem. So look, there's been a pause on the AI Act at the moment as people start to consider what to do. So the fact that you have the unified regulation in the US, I think, is interesting, and potentially it feeds into what people will do in Brussels.
You talked about the application layer, and companies like N8N, Lovable, they play on that as well. Is that where Europe wins? Europe wins on the application layer?
You know, I think that's very much our view. If you look at the application layer, that's really the next frontier. And whether that's in enterprise AI, you've talked to Synthesia here on the kind of video and learning and development side, whether that's on the cyber side, because if you think about AI, it's really expanded the vector of threats, the surface area around data, around identity, and then AI itself is an accelerator for the creation of new sort of cyber security. If you think about vertical in terms of bio, in terms of life sciences more generally, in terms of financial services, the amount of data that's available, because we're a stronghold in the financial services sector in Europe. And so I think there's a lot of potential here as we think about the kind of applied AI around enterprise, around verticals.
Does it matter if we don't have the leading foundation models, if we don't have the leading chip makers, if we don't have the full stack? Is that a risk for Europe?
I mean, in our view, at the end of the day, these are global initiatives. You have the big frontier labs, but you also have the open source models. And what we're seeing is the innovation that's happening now. It's happening really on top of these models. We think about it a bit like scaffolding, which is what are you building to stay ahead of the models? What are you choosing to really verticalize or use the data or the proprietary advantage you have? So that's a data moat. That's very much thinking about what is the specific use cases that you have that nobody else can quite do. And you know, we have a real open source heritage in Europe here. It's always been something that is very close to the minds of the European developer community. So our view is that you can just build on top of the frontier labs from a data perspective and from a workflow perspective, because what really matters is, are you embedded in the enterprises? Do you have end-to-end kind of use? Are you a system of action, even if you're not a system of record? And that's the opportunity that we're seeing in applied AI in Europe. Is Europe looking slow to adopt some of these solutions? You know, I don't think it's looking slow per se. Like I said, you know, if you look at the traction of companies you mentioned, Lovable is one of our businesses that got to 100 million in revenue in just 8 months. And then you have, it just doubled again 4 months later. Lovable is a company where there's almost 100,000 projects a day that are built from 200 countries. So I think once you have, because everyone's online, everyone can access, everyone can afford it, because the cost of inference has plummeted over the last 30 months. So our feeling is that actually the growth is stupendous as long as you have the right product market fit, and N8N is a similar example. What is looking overhyped to you at this point, Sonali? Look, I think in every technology shift, and this is no different, it's the old adage, you kind of overestimate in the short run and you underestimate in the long run. The structural shift is very meaningful. And so, of course, the AI paintbrush is sort of being used on all assets. And so there'll be winners and there'll be losers. Our view is the winners will be very meaningful. I mean, overhyped, I don't think anything is overhyped in the long run. But in the short run, it's still very early days for, you know, kind of embodied AI in terms of robotics. Super interesting, but very early in kind of mass market use cases. So, I mean, I think it's more about how long it takes for some of these sectors to really take off. Okay, Sonali, I had 101 other questions, but we've run out of time, but really appreciate your insights coming in bright and early for us this Tuesday morning. Thank you.
Into the studio, of course. Sonali, Rycker, Accel, partner and a key name behind some of these big investments in Europe on the technology frontier, of course. Staying on tech, on Friday, Bloomberg Tech Europe will take a deep dive into ASML. It is Europe's most valuable company, one of the most important cogs, of course, of the global AI supply chain. I've been speaking exclusively with the CEO, Christophe Fouquet, about Europe's place in the AI race and whether there is an AI bubble. That is at Friday at 6:30 a.m. London time here on Bloomberg TV. You can also watch on the terminal and, of course, on YouTube as well. There's a lot more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. So, of course, the Fed decision coming through on Wednesday, tomorrow, and expectations, at least for some in the markets, that you may get what is described as a hawkish cut, maybe, of course, pairing some of those bets into 2026 in terms of how far the Federal Reserve can actually go. Now, there is a continual debate in terms of high yields and what that actually means for the equity markets. But what you have seen, of course, over the last 30 days, over the last month, is essentially a flatlining for the S&P 500 at a time when those yields have creeped high, particularly at the long end, in terms of 480 right now in the 30-year, the flatlining of the S&P 500. So is that starting to come to play right now? To what extent can high yields cap and will cap the equity moods going forward? We can turn it on and have a look at the surveys that's coming through from Goldman Sachs as we push into 2026 then. Let's flip the board on those views then. And actually, you're getting a slightly more conservative take from some of those institutional clients of Goldman in terms of the response to their surveys, in terms of the views of between 7,000 and 7,250 by the end of 2026. There's just 12% expecting 7,500, and that to be the closing level for the S&P 500. That is moderated pretty significantly just from October, when there had been views that you'd be getting around 7,200 just by New Year. So that adjustment, a little bit more conservative. Yes, the gains will come through, is the expectations, of course, for 2026 from these institutional clients, but maybe slightly more modestly than had previously been expected. Let's flip the board and have a look at what's Nvidia, of course, because this will be central to any views about how much further the run-up for the S&P 500 and the Nasdaq 100 can go in terms of next year. The news, of course, the H200s can now be sold into the Chinese market with, of course, that 25% cut for the US Treasury. Will China open the doors to those imports is a key question. The opening trade is up next. Called high, of course, after hours. This is Bloomberg.